Welcome to our comprehensive review of the global economy in 2025. This year will be remembered not for crisis or collapse, but for what we're calling deceleration without disruption. Let's explore how this played out, quarter by quarter. As you can see in this chart, the cumulative weight of 18 months of monetary tightening finally bearing down on economic activity. In the United States, the Federal Reserve held rates firmly at 5.25 to 5.5%, even as inflation remained stubbornly elevated at 3.2%, well above the central bank's target. Meanwhile, China experienced what appeared to be a growth surge, but this was largely artificial. Exporters were rushing shipments ahead of anticipated tariff increases. This masked the continued weakness plaguing the property sector and domestic consumption. Europe presented a mixed picture. Industrial output remained completely flat, though there was some relief as inflation retreated to 2.5% with easing energy pressures. As you can see in this chart, the lag between peak policy rates and the inflation response became the defining dynamic of early 2025. The second quarter brought what central banks had been waiting for: meaningful disinflation. U.S. inflation fell into the high 2% range, while Europe reached 2.3%. But despite this progress, policymakers remained cautious. The Fed pointed to resilient labor markets, with roughly 175,000 jobs being added each month, as reason to resist any premature easing. What really changed this quarter was the trade environment. New tariffs and counter-tariffs weren't just threats anymore, they were being actively implemented, fundamentally reshaping global supply chains and forcing companies to rethink their investment strategies. And look at this trade volume chart. China's export momentum from Q1 reversed sharply as external demand softened. The spike you see in Q1 was that front-loading we mentioned, followed by a dramatic pullback in Q2. This exposed the underlying fragility that the earlier surge had masked. Against widespread expectations of continued weakening, the third quarter revealed surprising economic durability. U.S. consumers kept spending, particularly on services, keeping growth above 2% despite all the headwinds. Financial markets began pivoting their focus from pricing inflation risks to speculating about when rate cuts might begin in 2026. Meanwhile, safe haven flows increased globally, though this reflected rising geopolitical uncertainty rather than any systemic financial stress. In China, a deliberate structural transformation became unmistakably clear. High-tech manufacturing and green energy exports surged, while traditional sectors and domestic demand languished. This wasn't accidental. It reflected Beijing's strategic decision to prioritize industrial upgrading over broad-based stimulus. This chart tells the story beautifully. Manufacturing contracted across all three major economies, shown in red, while services expanded robustly, shown in green. The global economy was splitting into two distinct tracks.
By year-end, the cumulative effects became undeniable. Global growth converged around 2.6%, a full percentage point below the pre-pandemic trend of 3.6%. This represented a fundamental reset in growth expectations. The United States saw deceleration accelerate as pandemic-era excess savings were finally exhausted. Europe remained trapped at just 0.8% annual growth, and China's headline figure of 4.8% masked acute regional inequality. Coastal export hubs were thriving, while interior provinces struggled significantly. Central banks found themselves in a bind. Inflation had eased to between 2.5 and 2.8%, much closer to target, but not quite close enough to justify aggressive policy easing.
This waterfall chart breaks down exactly how we got here. Starting from 3.6% growth in 2019, monetary policy drag, trade friction, and weak domestic demand each chipped away at global growth, leaving us with this new, lower baseline of 2.6%. Looking at the full-year numbers, 2025 delivered modest global growth of 2.6%, down from 3.0 in 2024. But the headline masks a critical divergence. Advanced economies averaged just 1.5% growth, barely above stall speed. Emerging markets, by contrast, averaged 4.0%, demonstrating notably greater resilience. This bifurcation between developed and developing economies became more pronounced than in any recent year. On inflation, by December, the U.S. stood at 2.7%, Europe at 2.4%, and China at just 0.5%. Progress had been made, but that last mile to the 2% target proved stubborn. Policy rates remained elevated, the Fed at 5.25 to 5.50, the ECB at 3.0. This higher-for-longer stance constrained central bank flexibility throughout the year, limiting their options for supporting growth. 5 interconnected themes shaped the economic narrative throughout 2025, and this radar chart shows how each theme evolved from the start of the year to the end of the year. First, monetary policy. We saw a transition from peak restriction to what became known as a cautious, higher-for-longer pause. Second, trade architecture. Fragmentation accelerated from a theoretical concern into operational reality, actively impacting supply chain decisions. Third, China's evolution. The gap widened dramatically between a high-tech, export-led growth model and persistently weak domestic consumption. This wasn't a bug, it was a feature of Beijing's strategic choices. Fourth, inflation dynamics. The decline proved uneven and sticky, especially in services sectors where wage pressures remained elevated. And fifth, the overall growth character. This year's defining feature was deceleration without crisis. The economy slowed, but demonstrated surprising underlying resilience. Each of these themes intensified over the course of the year, creating a complex environment where traditional policy tools proved less effective than in past cycles. This scatter plot brilliantly captures the divergent regional outcomes in 2025. The horizontal axis shows GDP growth, the vertical axis shows inflation, and bubble size represents economic scale. Europe, shown in red, found itself in the worst quadrant, low growth at just 0.8%, with inflation still at 2.4%, a true stagnation trap. Japan, the smaller blue bubble, achieved relative stability, with 1% growth and 2% inflation, exactly hitting its inflation target while preserving modest expansion. The United States, the larger blue bubble, experienced late-cycle slowdown dynamics, 2.1% growth with inflation at 2.7%. Services remained relatively strong, but manufacturing contracted. China, in teal, sits in what looks like the ideal quadrant, high growth at 4.8% with low inflation at just 0.5%. But remember, this masks that acute regional divergence we discussed, coastal hubs thriving while interior provinces struggled. And emerging markets, in green, showed the most divergent outcomes, with commodity exporters and manufacturing hubs experiencing vastly different trajectories. So, what did we learn from 2025? The lessons differ depending on your perspective. For investors, 3 critical takeaways. First, duration matters again. A normalized interest rate environment restored the traditional importance of bond yields in portfolio construction. Second, geographic divergence created meaningful opportunities for active allocation strategies. This wasn't a year where passive global strategies thrived. And third, trade fragmentation introduced a persistent risk premium that requires careful positioning and hedging. For policymakers, equally important lessons. First, the real costs of higher for longer became visible. Restrictive policy, while necessary to tame inflation, visibly constrained employment, investment, and overall economic potential. Second, that last mile of disinflation proved to be the hardest, progressing unevenly across sectors and regions. And third, perhaps most significantly, trade policy now shapes growth outcomes as powerfully as monetary policy. Central banks are no longer the game in town. This timeline on the right visualizes the key turning points throughout the year, from peak policy impact in Q1 through manufacturing services split, tariff implementation, market pivot in Q3, and finally, growth settling at a new baseline in Q4. The bottom line? 2025 wasn't a crisis, it was a fundamental adjustment to a new economic regime.
As we close out 2025, we're left with a fundamentally different economic landscape than the one we entered with. The post-pandemic normalization is complete, revealing an economy operating under structurally higher interest rates, fragmented trade relationships, and a lower growth baseline. But this foundation sets the stage for critical questions heading into 2026. When will central banks finally pivot toward easing? Can China successfully rebalance its economy away from export dependence? And what scenarios should investors be preparing for?
We'll explore all of these questions in our next analysis, the 2026 Global Economic Outlook. Make sure to subscribe so you don't miss it. Thank you for watching, and I'll see you soon.